And leave it to contrarian badass Reggie Middleton.
Reggie walks in looking really cool. He's got a Google Glass on, and I'm like, man, that's cool. And
did he walk
what did
like
you?
that?
Yeah, he walked like that. That's how you walk if you've got Google
like
Glass
that?
on. Everyone walks real cool.
Nuts.
He called the housing crash. He called the collapse of Bear Stearns and Lehman Brothers. He's been harping on the crisis in the Eurozone banking system for years now, so he's just the guy to talk to.
Reggie Middleton.
Reggie Middleton.
Reggie Middleton.
Oh, he doesn't mince his words. We're talking about Reggie Middleton.
Ooh, it's Reggie Middleton.
Greetings all, Reggie Middleton back. So, let's talk bubbles again. Again, this is a gift from Marjorie Merriman, who is a director at VPRO, which is the Dutch version of the BBC. They've done very, very good reporting on the derivative crisis, the credit crisis, program trading, high-frequency trading. You know, many of them starred and co-starred yours truly, this handsome brother right here. And the reason why I have these Dutch tulips up is to discuss bubbles once again. Okay, before we were talking about bank equity. Bank equity seems like it's heavily discounted, potentially undervalued. I hear that many people are trying to double up on calls on Deutsche. Not necessarily a bad idea. A trading bounce, I could see that possibly happening. Medium term, from a fundamental perspective, bank equity, done. One reason is because one of the largest and true, the true banking business is supposed to be lending, okay, getting interest on loans. Now, a lot of banks in the zero interest rate policy, period, ZIRP and NIRP in Europe, negative interest rates, have a problem making money doing old school banking. But even before ZIRP and NIRP, a lot of banks reached way past normal lending because they wanted to juice their profits. In the US, where the big investment banks were partnerships, they sold their partnership units out to the public and became public companies. As a result, they were flush with cash and they were able to expand. So instead of doing a lot of the regular underwriting and lending, these banks started reaching into very arcane and esoteric businesses. These businesses threw out much higher margin profits, and during boom times, they really boom. But guess what? During bust times, they really go bust. Now, this quick synopsis, this quick historical snapshot is to give you a perspective of what happens when the banks can't make money. When the banks do make money, the vast majority of the loans in both the US and in Europe go to mortgages. Consumers and corporates, they borrow money to buy property. Property has went through a significant bubble. 2006, 2007, and 2008, the year after it started to pop, at least in the northeastern New York area, and much of the United States, saw the fastest increase in property prices and probably the largest property prices in the history of the United States and in Europe. Wow, that was a big bubble. Lehman went down, Bear Stearns went bust. A lot of pundits were saying it's the end of the world, which never ever buy that. It doesn't matter. Banks have been going out of business for 2,000 years, and every day the sun rose. It doesn't matter how many banks go out of business. The world is not going to end. A particular banker's bonus pool, Azimut yacht purchase, etc., may come to an end. But the world goes on. There are a lot of entities who are willing to take place of banks, including our Veritasium, our technology concern. But that's another story. Moving forward, everybody remembers that, or most people remember that big bubble and that bust. You remember what happened? Well, guess what? That bubble is back, okay, in a different form and flavor, and that bubble is back more so than before. If you take a look at certain markets, the prices have went above the 2007-2006 peak, significantly above. We're talking about New York City, and the condo market. Not quite. So, housing prices go up, right? Most banks are not making much margin because of net interest margin compression. When these housing prices go down, what happens to the banks? 2008 all over again. But this time around, you don't have this basket of QE that was implemented by Mr. Bernanke. You can't drop rates. They're very close to zero now unless you go negative. Going negative is what happened to many of the banks in Europe, i.e. Deutsche Bank, Commerzbank, etc. So what do? It looks like they've shot up all their ammunition. Now they can invent new things, but the problem is those new things that they invent will most likely recast what happened last time around. You never fix the problem. Insolvent entities need to go out of business. That's the way true capitalism works. Unfortunately, US, the alleged bastion of capitalism, is none of the sort. And the EU seems to be worse. Okay? You'll see what's going to happen to the European banks and the European insurers shortly. Peace.